The United States and Israel launched coordinated strikes on Iran while markets were closed this weekend. This video is not political. It's not about taking sides, and it's not about opinions. It's about understanding how financial markets historically respond to events like this, so as investors we can make rational decisions instead of emotional ones. Right now, before a single stock market bell has rung, global assets are already being repriced, and millions of retail investors are sitting at their phones asking the same questions. What do I do? Should I buy? Should I sell? Or do I sit still? And today I'm going to walk through how markets have reacted to similar geopolitical shocks in the past, what actually drives recoveries, and how to think through this in a disciplined way. Here is what history shows. We've been here before, almost exactly here several times. January 3rd, 2020, the United States carried out a strike that removed one of Iran's most senior military leaders. It was one of the most significant direct US-Iran military actions in decades. The next trading session, the S&P 500 dropped modestly. Defense stocks like Lockheed Martin jumped more than 3%, oil spiked, gold surged, airlines pulled back. Within days, the broader market had retraced the move. Within about a month, it was making new highs. Markets ultimately price cash flows, and unless those cash flows are permanently impaired, geopolitical sell-offs often prove temporary. Now, this isn't opinion, this is historical data. I'm not trying to predict whether or not this continues further or it escalates, but this is about the investor framework and how to think clearly when volatility spikes and emotions run high. Now, a quick reminder, everything here is financial education, not financial advice. I'm not a financial advisor. Always consult a professional before making investment decisions. And if you find this helpful, please consider subscribing and joining the free newsletter in the pinned comment below. Now, let's walk through this step by step. Iran is not a random player in global markets. It is one of the top 10 oil-producing nations on Earth, pumping roughly 3 million barrels per day. But more critically, Iran sits at the edge of the Strait of Hormuz. You need to understand what that means. The Strait of Hormuz is a waterway about 21 miles wide at its narrowest point, and through that channel moves roughly a fifth of the world's petroleum liquids, plus a major share of LNG flows from Qatar. It's the definition of a choke point. And here's what matters to us investors. Oil isn't just something we put in our car. It's built into transportation costs, airline margins, shipping routes, manufacturing inputs, even inflation expectations. When oil spikes, it doesn't just stay isolated in the energy sector. It moves through the entire system every single day. Saudi oil, Kuwaiti oil, Iraqi, Emirati, Qatari, LNG, all of it threading through that bottleneck before it reaches the world. Iran has threatened to close that strait multiple times. Now, they haven't done it in a sustained way, but the threat alone is enough to move oil markets. Because oil traders don't wait for disruption. They price the probability of disruption. And that's why this event matters to your portfolio in a way that most geopolitical headlines simply don't. Now, here's the second reason this moment matters, and I want to say this carefully. Some of what I'm about to explain can sound scary if you're a retail investor, so don't hear it and instantly think that you need to hit the sell button. There's a smarter way to handle this, and I'm going to walk you through some key things to think about. A lot of the risk has been getting priced in quietly through the last few weeks, especially across rate-sensitive areas like financials and high-growth tech, because tensions in the region have been building in plain sight. And that matters because we're walking into this with price pressures already sticky. The latest data shows producer prices rising faster than forecasted, with core wholesale inflation hitting 3.6% annually, which is its highest level since nearly a year, signaling that price pressures are still trickling down the supply chain. The Federal Reserve is already walking a tightrope between wanting to cut rates and not being able to justify cuts if prices stay higher. If oil stays elevated for even 4 to 6 weeks, then that calculation shifts completely. Higher oil feeds directly into the consumer price index. Now, if CPI stays elevated, it raises the odds the Fed stays higher for longer. And rate-sensitive assets, high-growth tech, real estate, anything priced on cheap future capital gets hit harder and stays down longer. Now, that is the chain reaction. And understanding it is the difference between reacting to a headline and actually reading what markets are telling us. The January 2020 US strikes on Iran are the closest historical parallel to what's happening today. A direct, high-profile US military action against a senior Iranian target, and here's exactly what happened. Defense was the immediate winner. Brent crude spiked nearly 4%, pricing in Hormuz risk that ultimately did not materialize into a physical disruption. Gold surged as investors fled to safety. Airlines and travel names got hit, higher fuel costs, airspace concerns, route disruptions, to name a few. And then Iran retaliated. They launched ballistic missiles at U.S. military bases in Iraq. Overnight, markets wobbled and risk assets sold off briefly after the missile retaliation. The situation looked like it could spiral, but it didn't. Within 7 trading days of the initial strike, the S&P 500 had fully recovered. Within a month, it was at new highs. The Gulf War, 1990 to 91. Iraq invades Kuwait. The U.S. builds a coalition and enters. East oil supply is directly threatened. The S&P 500 falls. After Iraq invaded Kuwait in 1990, the S&P went on to deliver roughly 10% over the next 12 months as the conflict played out. Russia-Ukraine, February 2022. Not Iran, but the same framework applies. A geopolitical shock with direct energy implications. After an initial 5 to 10% drawdown around the invasion, the initial invasion shock was retraced within months. Even through the broader 2022 bear market later unfolded for separate macro reasons. The people who panic sold at the bottom of that dip locked in real losses. The people who held or looked for opportunities and bought the dip came out ahead. And here's the data that ties all of this together. Across major geopolitical conflicts over the past 50 years, studies show S&P 500 typically experiences a short-term drawdown followed by quick recovery and positive 12-month returns. Geopolitical shocks only become long-term bear markets when they damage corporate earnings. If profits keep growing, volatility tends to be temporary. Through every single one of those conflicts, 2 Gulf Wars, Afghanistan, the Russia-Ukraine escalation, multiple Middle East tensions, the S&P 500 has done what it always does, up and to the right. The pattern is clear. The market does not care about the emotion of the story. It prices the economic impact, and unless there is genuine sustained supply disruption, it moves on faster than your feelings do. So let me show you a very interesting study by Bull Run Investment Management. As you can see, most of the time, major events happen like this. The market returns positive shortly after the initial shock. For example, you can see here that the Iran airstrike in 2020 had a 14.4% one-year return in the S&P 500. Similar patterns happen for most of the world major events covered in this study. Now, let me give you something practical. It's not a prediction, but a way to think through this in real time. I break geopolitical shocks into 3 phases: shock, repricing, and rotation. Most of these events follow a similar sequence. The timing can vary, of course. The severity can also vary, but the pattern is surprisingly consistent. Currently, we're in phase 1, the first 24 to 72 hours after the event hits the headlines. It's not surprising that this happened on the weekend. This allows the market to absorb the news before utter panic if the markets were actually open. And this phase is almost entirely psychological. What you feel in phase 1 is urgency. It feels like everything is moving fast and you need to do something immediately. And that's not weakness, that's actually just our biology. Our brain is wired to detect threats and react. Fight or flight. Act now, figure it out later. The problem is that instinct is incredibly expensive in the stock market. Because while you're feeling panic, institutions are not. They're executing. The large asset managers and hedge funds that saw tensions building over the last few weeks didn't wake up surprised. They already added energy. They already hedged with options. They already tilted towards defense. Phase 1 is not when professionals decide what to do. And this is where retail investors make the biggest mistake. They try to chase what already moved. They buy oil after it's up 5%. They sell tech after it's already down. They react to the move instead of asking whether the move is actually sustainable. So phase 1 is loud. It feels dramatic, but most of the time it's information being processed, not the end of the world. Okay, so phase 2, this is the repricing phase. The panic has settled. Now here's what we can watch, and I'll keep this simple. First, look at the 10-year Treasury yield. If yields are dropping, the bond market is telling you it thinks the economy is slowing down, which actually brings rate cuts back into the picture. If yields are holding steady or climbing, inflation expectations are sticking. That matters for everything, from your mortgage to the valuation of your tech stocks. Second, and this one's actually underrated, Watch whether energy and defense are still leading the market. Because if 2 weeks in, money is quietly rotating back into tech and growth names, that's the market telling us it's already moving on. That's phase 2. The dust is settling, the real repricing is happening. Here's the single most important insight I can give you about phase 3. Most retail investors are still processing phase 1 when institutions are already operating in phase 3 rotation. The people who lose money in events like this aren't always the ones who sold. They're the ones who sold late and sat in cash watching the recovery unfold without them. Look, I'm not going to give you a 12-point checklist here. Honestly, there are really only 2 things that matter, and they've worked through every single one of these events over the years, going back decades. Don't panic sell and don't chase the spikes. And don't assume that every geopolitical event equals a financial crisis. That's it. The people who got hurt in 2020 weren't the ones who held through the news. They were the ones who sold into the fear and then watched the market hit all-time highs a week later while they were sitting in cash trying to figure out when it was safe to get back in. That moment never feels safe. That's the trap. And the people who piled into oil stocks or defense names the morning after the news broke, right when those things were already up 4 or 5%, most of them gave those gains right back within a month when the risk premium faded. Your boring long-term positions, leave them alone. That's what they're built for. So how do you play this without panicking? You slow down. You let the first emotional wave pass. You watch oil, you watch the 10-year yield, you watch credit spreads. If those stabilized and high-quality tech and software names are sitting 8 or 10% lower on no change to their earnings outlooks, that's when long-term capital steps in quietly. You don't try to catch the exact bottom. You don't go all in. You scale. You rebalance. You add to strength in quality names when fear gives you a discount. And here's the truth most people don't want to hear. Volatility is where long-term money gets made. Not because war is good, but because fear temporarily misprices risk. If this stays contained, markets recover before headlines feel comfortable. And you want to already be positioned when that shift happens. If it drags, you tilt towards balance sheet strength, pricing power, cash flow, and selective energy exposure, not speculation. You don't need to predict the future. And honestly, one of the best things you can do in moments like this is just stay consistent and keep dollar cost averaging. That simply means investing a fixed amount at a regular schedule, regardless of whether the market is up, down, or all over the place. When prices dip, you naturally buy more shares. When they rise, you buy fewer. Over time, that discipline smooths out volatility and removes the pressure to get it exactly right. Thanks for watching. Please drop a comment. Which scenario do you think we're heading into as we move forward into this week? I read every single comment. See you in the next video. Please subscribe if you haven't already, and thanks for watching. Take care.